Hey, it's Mike. I am not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we are talking about the 10-month Tsly return. And these are the results. And then I'll just have some commentary on my actual thoughts here. So one of the key pillars that I tout on this channel is you borrow money. And with borrowing money, you have to invest in something that pays more than you can borrow. So one of the holdings that I invest in is a fund called TSLY. It is by YieldMax. They sell synthetic covered calls on Tesla stock. And over here, it says it distributes 55.92%. So in theory, if you are getting income that is 55.92% a year and you can borrow at 8%, that is a winning formula. But what is said and what the actual results are two different things. So that's why we're going to go in the details and we're going to go through it here. So first things first, my overall portfolio, 141,831. One of the other important things that I tout on this channel is that you should not borrow more than 10% of your overall portfolio. If you're borrowing more than 10% of your overall portfolio, you start putting yourself in a little danger zone because then you're going to be overextending yourself. So I really push only 10% of your overall portfolio is allowed to borrow money. And there's another thing that I will discuss here in just a moment, but 141, a couple different holdings. The backbone of my income investing is Tsly. I did add JebQ, QQQY, FEPI, and QTDT. With that, whatever I get paid my reinvestment, my 25%, it gets spread into these 5 holdings. But predominantly today, I'm just going to focus on Tsly. Okay, so the buying power here, you can see here, we are at a low risk. We have a pretty massive margin buffer. So we have about $80,000 of protection here or downside where my portfolio would go down before I get margin called. I'm not going to necessarily discuss too much about margin called. I'm sure there's millions of other YouTube videos that could explain it, but you just don't want to be margin called because then your account sells your portfolio assets at a loss. But here in Robinhood, I could borrow money at 8%, and my daily interest rate is 3.67%. Okay, I'm going to focus on Tsly because it's the backbone of my portfolio, and that's where I get most of my income. But as the reinvestment keeps kicking in and that compounding machine really starts working, we'll start seeing these other holdings ramp up. And then when I do hit my other tranche, so once my portfolio value hits 300K, then I'll take the extra 10K that I unlock to invest into those holdings. But we're just going to focus on Tsly on this one. So you can see here, YieldMax Tesla option income strategy. What they do, they buy a call a couple months out and they sell weekly covered calls off of it. 1 day performance up 4%. Tesla went up 4%. So overall, for the last week, we're down 6. Last month, 6.69, 3 months, year, 5 year or whatever, we're down 48%. But that is because the underlying is not doing well. Once Tesla recovers, I'm telling you, we're going to get that price appreciation as well as massive dividends. But right now, we're not winning right now. Market value is here, loss is here. And the other thing I was mentioning earlier is, one of my pillars is, having income that pays more than you could borrow. The other thing is only 10% of your overall portfolio value and margin. And the last thing here is making sure you invest in holdings that only have a 25% maintenance requirement. So for example, say your margin balance, I shouldn't say margin balance, your maintenance requirement is $50,000 and you decided to invest $100,000 into this, your margin maintenance line would only go up $25,000. So if you had $50,000, 25% maintenance requirement on $100,000 is $25,000. So technically your margin line is $75,000. So that's why you want to have this low maintenance requirement. I used to sell covered calls on Tesla, and Tesla stock used to be 100% maintenance requirement. And you really just want to focus on maintenance requirements that are 25%. Not going to necessarily go through the actual holdings of YieldMax, but what we are going to show is the actual income that is going to be paid here. So I have 1,000 shares. We're getting paid 68 cents a share, which will come out to $688.73. I did get a $4 QQQY payment. But for the most part, that is going to be the payment for YieldMax for Tsly. So now going to my account, we're going to go to the investing tab. We're just going to go through a couple more metrics here, and then we will go to the spreadsheet. So our margin is enabled because we margin invest. We're only margin investing 10% of our portfolio. We're utilizing $17,789 in margin, which gives me a margin maintenance of $61,000. So going back to my other example where the maintenance requirement is 25%. So if I decided to borrow $100,000, it would only reflect $25,000 onto this number right here. So add 25,000 to this, and that would be your margin maintenance line. But again, I don't want to overextend myself. 10% is a good number right now until we can determine that this is actual feasible strategy. Moving on over to this side, when my portfolio value was $200,000, 10% of 200,000 is 20,000. So I give myself a 20K margin available limit. You can tell that that is the amount of margin I'm using. I put in $125 a week of my W-2 income. And this is the outstanding margin interest. So, if you expand out the 367 of daily margin onto this for the next 10 days, that will tell me how much my expenses will be. But I already did that in the spreadsheet. So actually going to the spreadsheet, we're just going to kind of go line by line here. So I don't know if I mentioned this in the last video, but I added this new section called, it's like the portfolio yield. And this is prior to expenses, taxes, and reinvestment. So what I did is whatever the total price I paid for all those income holdings. So this is counting for Tsly, FEPI, JEBQ, QDTE. I counted for all of that. And whatever this payment was, I divided it by, I did this number divided by this number, which gave me 2.48%, which again is a lot different than this number. It says 55%, but this is the actual yield for my portfolio. So sometimes with these funds, they try attracting you with these massive numbers, and this is the actual payments here. So 2.48% monthly, which would come out to a yearly percentage of about 30%, and the estimated income. So if you annualize this number for 12 months, you would get $8,300. But I will say, for only having $28,000 invested and getting paid $8,300, that is a pretty solid number. Okay. Income fund value. So again, I added all the income funds that I had, Tsly, JEBQ, all those ones. That's the total value. Again, this is the price paid. And this price paid is also accounting for this reinvestment. And then that reinvestment didn't account for the new amount of dividends. So again, it might be slightly off, but once I do the reinvestment, I just add that number in right away. So we'll probably see a higher number for the next month. But to me, the couple percentage points off is not a big deal. But price paid here, you can see the performance. Again, the performance is down because Tesla is down. The majority of my portfolio is in Tsly or in Tesla synthetic covered call funds. But then I am divesting with my reinvestment into those other holdings. And then when I do unlock that other tranche, I will be investing a lot more heavily into these funds over here. But carry on. Again, I'm telling you, price appreciation will come back. Those massive dividends will come back. And then everyone will be crawling back saying, wow, I wish I invested in Tsly when it was down. Total income. So I've been investing into this style of strategy for about 10 months now, and I've gotten paid $6,234. And this is the total expenses, $784.30. So by only paying $784.30 to get $6,200, that seems like a pretty fair trade-off to me. But again, with borrowing money, there's always risk, but this, with the way that I am doing it, with the 10% overall portfolio and margin, the 25% maintenance requirement, investing in higher income paying items and stocks and assets, it kind of limits that downside risk. Because if you just invested in a growth holding that doesn't pay a dividend, that's a lot higher risk than investing in a holding that pays monthly dividends. And you can see here for this month, I'm already past my total taxes compared to last year, but it is return of capital. So once you meet your return of capital, you then are taxed at short-term capital gains. I am very conservative when it comes to taxes. When I was selling covered calls on Tesla, I was making an immense amount of money, but then I wasn't setting aside money for taxes. And then I had a massive tax bill So I just automatically set that money aside. If I have money left over after taxes, then I pay the margin down, or I'll have more money to reinvest. But I just don't want to be caught not having money for taxes. It is not a good feeling. Base reinvestment here. So, every single time I get, this payment, I reinvest back in 25%. With that 25% reinvestment, even if your underlying is depreciating in value, but you're still getting decent income, you're getting a solid income over 15, 20, 25%, you can still grow your portfolio as well as the stream of income. And then net gain here. So after all your expenses, taxes, your reinvestment and expenses, this is how much money you truly have left. So, what you're doing is you're fortifying your position. You are, you set the money aside to make sure your money keeps growing and the payments keep growing. You set the money aside for Uncle Sam, and then also the amount, the financing expense, you set that all aside. This is the actual money you have left over. And having an extra $200 really just clicking some buttons on the internet, that's incredible. And then think about this. If you were able to scale it, say, if you did 100 times, $100,000, you do this 2-3 more times, that's $600 where you don't necessarily need to actually lift your fingers to work. You're not painting walls. You're not picking up trash. You're not doing any of that stuff. You're just clicking buttons. Moving on. So yes. Okay. So going back to here, since we talked about the net gain, overall net gain, $2,100. So then let's just talk about the actual full April numbers here. So April, again, that's the amount of money we have. This is the amount borrowed. It is slightly off compared to the other holding because I did buy the reinvestment stuff. So that just applied to it. So total margin percentage. So about 62% is still in margin. The other 48% is owned by the actual outright. So, over time, this margin percentage is going to go down. Total income, you can see the income here. So again, that is accounting for, there was a QDTE payment. There was a QQQY payment as well as a Tsly payment. The Tsly was the bulk. It was like 688, but I did add it in there. This is the expenses, total amount for tax set aside, reinvestment, that. Okay. Now monthly yield. So what I do is I take this number, divide by this number, which gives me a monthly yield percentage. So again, if you're getting an extra 0.1 over the span of a year, you'll have about 1.2%. And if the S&P 500 is returning 10% and you get 11%, you're outperforming the market. So just keep that in mind. And then this is the portfolio value, my account value at the time. So then getting an extra $197.30 gives me a 0.14% boost. So then again, after 12 months, that's about an extra percent a year. Again, if you're 1% higher than the S&P 500, you're beating the market. So a couple thoughts moving forward. I like what I'm seeing, even especially when Tesla share price is going down, it's still paying a substantial dividend. Once that Tesla share price goes up, again, we are going to reap the benefits. We're going to reap what we sow. So right now we just have to be patient. Whoever is invested in Tsly. So we gotta diamond hands it. We can't be paper handsing it. And, we will be rewarded for our patience and our diligence. But again, technically, because Tesla's down, our performance is bad. I'm not going to sit here and say that this is the best performing thing in the world. Now, if you look at the other holdings, for example, if you look at YieldMax or NVIDIA or something like that, we have been having price appreciation. It's the exact same strategy, and they're still up 10% a year as well as getting decent income. So all I'm saying is we just have to be patient for Tesla. But again, the overall price performance is not good. Income is good. The borrowing the money to get a side stream of income is working wonders. So, you know what? I really appreciate y'all watching the video. I hope, you're able to build this stream of income so you have more options for your future family. And I do really hope you all have a good one.